Welcome back to The Investor's Edge. I'm your host, Alex, and today we're tackling a topic that financial professionals talk about constantly, but that many retail traders tend to ignore: the ghost of zero, that paralyzing fear of losing it all. To help us unpack this crucial concept, capital survival, I'm thrilled to welcome a true expert in quantitative finance and risk management, Dr. Ben Carter. Ben, thanks for joining us.
Alex, it's a pleasure to be here. This is, hands down, the most important conversation any trader can have, and usually the last one they want to have.
That's a great starting point. The statistics are brutal, right? We often hear that over 90% of retail traders lose money, and a lot of that happens within the first year. Your research suggests this isn't primarily about market timing or technical analysis. It's about something more fundamental. What is that core failure?
Exactly. People think they fail because they bought when they should have sold, but the real failure is in capital survival. They treat their trading capital like an infinite pool, when in reality it's the fuel for their spaceship. If you run out of fuel halfway to the moon, your financial goal, it doesn't matter how perfectly you plotted the route, the journey ends. Most traders simply run out of fuel.
That's a brilliant analogy. When you talk about running out of fuel, you're referring to the risk of ruin, or ROR. Let's define that simply for our listeners.
The ROR is a definitive, probabilistic metric. It's the percentage chance that your account will hit zero. And crucially, it's not caused by bad luck. It's caused by deficient capital management and excessive risk taken per trade. I like to use the leaky bucket analogy. Your winning trades are the faucet trying to fill the bucket. Your losses are the leaks. ROR measures how big those leaks are compared to the speed at which you're filling the bucket. If the leak is too significant, meaning you're risking too much, the bucket will inevitably empty.
So even with the historically profitable trading system, you can still fail if your leaks are too big.
100%. Think of the analogy of a card counter in a casino. They might have a 55% statistical edge over the house. They should win long term, but if they bet half their capital on every single hand, a losing streak of just 2 hands means they're bankrupt. Losing streaks are a statistical certainty in trading, and most amateurs aren't planning for them.
That helps distinguish ROR from something like maximum drawdown. Can you clarify the difference between those two?
That's a crucial distinction. Maximum drawdown is a retrospective metric. It looks backward and says what was the largest historical drop from peak to valley in your equity account. If your $10,000 account dropped to $7,000, your max drawdown was 30%. It's history. ROR, on the other hand, is a prospective metric. It looks forward and calculates the future probability that your drawdown will reach 100%. A trader might have survived a 25% drawdown in the past, but if they start risking 20% per trade out of desperation or revenge, their ROR instantly skyrockets, dangerously approaching 100%.
That ties directly into the science you mentioned. You have to know your system's math. What are the key statistical inputs a trader needs to calculate their ROR?
There are 3 vital variables, and you have to get them from rigorous backtesting, not guessing. P, probability of winning, your verifiable win rate. Q, probability of losing, which is simply 1 minus P. R, reward/risk ratio, your average profit divided by your average loss. Once you have those, you can start applying serious mathematical tools like the Kelly criterion.
I've heard that term before, the Kelly criterion. It sounds very academic, but it's central to optimal betting, right? How does a trader use that?
Its main purpose is to determine the optimal position size, the fraction of your capital to bet that maximizes long-term growth. The formula is F equals W times R plus 1 minus 1 divided by R. Now, you don't need to memorize the formula, but you need to know what it tells you. It gives you the full Kelly amount. For example, if your system suggests an optimal risk of 25% per trade, that's the optimal mathematical path to wealth. But, and this is a huge but, full Kelly comes with an inherently high ROR and 0 margin for error. If your real-world stats deviate even slightly, you're toast. That's why professional money managers universally recommend fractional Kelly, like Kelly by 2 or Kelly by 3. If full Kelly suggests risking 25%, you should only risk 12.5% or even 8.33%. That reduction gives you a robust margin of safety.
That makes sense. The real world isn't static. Markets change. How do professionals test for those consecutive worst-case scenarios, like when 10 bad trades happen in a row?
That's where the Monte Carlo simulation comes in. The Kelly formula is great, but it's static. Monte Carlo is dynamic. You input your historical P&R, and the simulation runs thousands of random trade paths. It tracks how many times the capital drops to zero. If after 10,000 simulated paths, 500 of them result in ruin, your ROR is 5%.
That's terrifyingly practical.
It is, and the actionable takeaway is this. An acceptable ROR for a professional should approach zero, ideally less than 1%. If your simulation shows 5%, you immediately adjust your risk percentage downwards until you hit that 1% target. That rigor is your financial authority in action.
The golden rule, the 1% or 2% dogma. All right, let's move from calculation to prevention. Once we know the math, what is the single most powerful tool for avoiding ruin? What is the golden rule?
It is the dogma that separates the professionals from the gamblers, the 1% or 2% risk per trade dogma. You must never risk more than 2% of your total capital on a single trade. For the conservative, long-term survival strategy, the 1% rule is the absolute handbrake.
So if I have a $10,000 account, my risk, the distance from my entry point to my stop loss, cannot exceed $100.
Correct. That's your handbrake. Think about the power of that. If you lose 10 consecutive trades, which happens to even the best, I promise, you have only lost 10% of your capital. You have 90% left to recover. If you risk 10% per trade, those same 10 losses mean total annihilation. The 1% rule keeps you in the game. It's what allows you to survive drawdowns and gain the experience necessary to be a better trader.
That manages the amount of money you can lose. But how do you convert that 1% into the actual size of the trade?
That's called optimal position sizing. It's the calculation that translates your fixed 1% monetary risk into the number of contracts or lots you buy. The size of your trade must always be inversely proportional to the technical risk of the setup. Let's say you have a $50,000 account. Your 1% risk is $500. If your technical analysis dictates a wide stop loss, say 100 pips, you must trade a smaller position size. If the stop loss is only 50 pips away, you can trade a larger position because the dollar risk is still capped at $500. Position sizing forces you to subordinate your ambition, how much you want to win, to your prudence, how much you can afford to lose.
That also brings up the subject of leverage. Most retail traders love leverage because they think it magnifies profit. Does it also automatically increase their ROR?
That's a fantastic question, and the answer is subtle. Leverage itself does not increase your ROR if you use a fixed stop loss and correctly calculate your position size based on the 1% rule. Leverage is a scalpel, designed for capital efficiency. It lets you control a large position with less margin. However, it is catastrophic in the hands of a novice. A beginner with a $1,000 account and 1-to-100 leverage might see a $100,000 position and ignore the 1% rule, which means a maximum risk of $10. If they base their position on the total $100,000 exposure, they instantly ignore the 1% rule and their ROR skyrockets, dangerously approaching 100%.
That leads perfectly into the human factor. We've established the math, but trading is ultimately done by people with emotions. When the math is perfect, what breaks the model?
It's almost always a failure of discipline, a surrender to emotional bias. There's a concept called loss aversion. The feeling of losing $100 is twice as powerful as the feeling of gaining $100. This aversion drives the most catastrophic mistakes, the capital sins.
Can you give us the top 3 sins that guarantee ruin?
Absolutely. Revenge trading. You've had 2 losses and now you're angry. You instantly increase your position risk to get back to even quickly. You just turned a calculated 1% risk into a 5% risk, multiplying your ROR tenfold. It's an emotional response to a financial event. Blind hope. You open a trade, it goes against you, and you move your stop loss, or you don't use one at all. You violated the fixed risk rule, and you've just exposed your account to an unlimited loss. That, by definition, drives your ROR to 100%. Overtrading, entering low-quality setups merely out of boredom or a need for action. This reduces your P, your win rate, and severely deteriorates your system's mathematical advantage. You're trading impulsively, not scientifically.
So how do we battle that, Ben? If discipline is the problem, what's the tool for fixing human behavior?
The trading journal. This is your scientific laboratory. It must go way beyond recording entries and exits. A professional's journal includes the emotional state upon entering and exiting the trade, where you rushed, where you stressed, the justification for the position sizing used, a note on whether the 1% risk plan was strictly respected. By analyzing this journal, you don't just find market patterns, you find your own psychological failure patterns. You might realize your system has a 60% edge, but your psychology causes you to violate the 1% rule on 1 out of every 5 trades. That inconsistency makes your ROR far worse than the math suggests. True profitability is the result of consistency and discipline.
That's a powerful final lesson. It sounds like a professional trader survival model is a triangle. You have the expertise of the math, the experience gained by surviving drawdowns, and the authority that comes from using a journal to execute your plan with iron discipline.
Well said. You have to keep the risk low to gain the experience, and you have to know the math to keep the risk low. It's all connected.